Good morning, good afternoon, everybody. My name is Mikhail Pritzker, Misha Pritzker. That's what people call me here. And I'm with Temple Family Funds and Syndications, more than 2 years right now. We're doing portfolio and asset management for this beautiful company. And here is Mike Zlotnik, the founder of this brand. And today we're going to talk a little bit about what's going on today, about market volatility, what is the potential need for diversification, and so on. So, Mike, hi, how are we doing?
Hi, Misha. Great chatting with you, and welcome everyone to this discussion.
Yeah, absolutely. So let's start from one thing. We've seen a lot of market volatility in equity stocks these days, like Nvidia, for example. Yeah, and all that sounds like a bit unhealthy, I would say, in a way, because that reminds us 2000 dot-com boom, and you never know what's going to happen. So, what lessons should investors take from this level of volatility, and why diversification today is more critical than ever? Give us a few words on that, please.
So there's laws of gravity in physics, and then there's laws of economic gravity. Things that come up too fast, too much, sometimes come down. There's a concept of reversion to the mean. So things could be high flying, but the higher they fly, the higher the risks associated with a potential correction. And not really predicting any kind of doomsday, just common sense to remember the past. What we get from
Yeah.
the past are lessons. And I clearly remember dot-com boom, and things corrected quite a bit from the peak. So when assets have done really well, they've appreciated greatly. It's only prudent to consider moving some capital from the heavily appreciated assets into what's undervalued, just for no other reason is to maintain healthy and prudent diversification. It's that simple. It's common sense.
Yeah, you're absolutely right. So, what risks do investors face if they stay overly concentrated in this speculative assets? What might happen to them?
And it's not just AI stocks. It's also crypto. Could be other high-flying asset classes. And I'm not advocating anything pro or against AI stocks or crypto. On relative basis, things appear to be uh, overvalued. And even Jay Powell at the recent interview, he acknowledged that the U.S. Asset prices are overvalued by many metrics. Again, from the central bank perspective, it's a different conversation. They want to see stability of the financial system. They don't really are not as concerned when the prices are have appreciated greatly. But from an investor's perspective, the risks are pretty significant. That there can be some kind of black swan event, a disruptive event, loss of confidence, change of the pattern that significantly dislocates the valuations. It may not happen overnight, or it may happen relatively quickly. It depends. So the risks have increased. And I had a conversation. I'll add just one more point. I have a conversation with a great friend who is significantly invested in crypto space, and he's sitting
Mhm.
on, let's call it, retired many times over type of portfolio, and he's emotionally attached to the appreciated crypto assets. Feels great about it, and there's a euphoria and a happy feeling. Things can go to the moon. That's a wonderful place to be. But at the same time, that friend contacted me a couple of days ago and said, Mike, I need to diversify into real estate. I know that I need stability of income, lower level of risk, and predictability in the retirement, in the manner of speaking. So these considerations start playing a bigger role when you have heavily appreciated portfolio into anything, especially if that asset class is very volatile. Things go up and down, and you want to remove volatility and be in something much more stable, at least portion of your portfolio. And my feedback to him, just a final point. Um, are you still going to have great upside after you liquidate a little bit of your position? Yes. And that liquidation, a little bit of your position, helps create some safety net and predictability of cash flow by taking a look into what's undervalued and what's predictable.
You're absolutely right. 100% agree with you. But getting a little deeper into that, and given today's economic climate, why do you think real estate, maybe especially multifamily properties, are more stable and predictable asset class compared to high volatile market stocks and crypto? Because if you go back to 2000 and dot-com boom, yeah, a lot of happened that days. A lot of jobs were overlaid, and people in reality started to rent more than buy. And multifamily had a great boost. I mean, at least it survived and was pretty stable. Now, speaking about an environment where inflation is not settled yet, it's still kind of somewhere. So why do you think that real estate is more stable and predictable as a class?
Sure. So the best way to look at this is relative value. So real estate typically trades as a function of the cost of capital because it's one of the leveraged asset classes. And residential real estate has held up even with rising interest rates, but commercial has certainly corrected significantly. So on a relative basis, the value of existing real estate investments, especially when you can buy them in a market where there are difficulties for sellers to sell the properties at the prices they want. It's buyer's market. The buyers have ability to negotiate better prices and get phenomenal deals based on many metrics, such as purchase relative to reconstruction cost, such as current NOI or the cap rate relative to the cash flows, current and future. So these relative metrics point to great value. When you're buying a property in a multifamily space, for example, at 9 cap rate, which is insanely great cash flow, you had the leverage on that. You have all kinds of downside protection. So on a relative basis, some of these multifamily assets in other parts of the commercial markets have fallen in valuation with the risen interest rates. As Fed pushed the rates fast and furious and kept them higher for longer, we're now seeing the environment where interest rates are at the elevated level, probably for some extended period of time. However, the rents are still growing. So what's the beauty about real estate on a long-term basis? You have predictability of the rent growth and increases, and also the interest rates today, by many metrics, are above where they need to be in a neutral level. So on a long-term basis, again, based on Fed goal of a lower inflation expectation, the inflation target of 2%, interest rates should come down at some point. So if you look at real estate from any angles, even if the interest rates don't fall, they just stay where they are. The assets trade at a remarkably great value if you can find a great deal versus some of these heavily appreciated stocks because their valuations are based on perfection. And again, crypto, it's not trading based on PE or any other metric in the form of future earnings. It's trading based on what the market price is, demand, supply, demand. Well, stocks like NVIDIA and other AI stocks, at least they have some forward PE projection. But on a relative basis, what Warren Buffett has taught us over the years, not following the great crowds, putting on a contrarian hat and looking where the greater relative value is what I'm talking about. So everything is in relation to other asset classes. That's why real estate, especially equity of some of these undervalued properties, is a great buy, great opportunity versus some of the heavily appreciated asset classes. They look fully valued or overvalued based on many traditional metrics.
So in a way, you're saying that since real estate is backed up by fundamental demand, it's more reliable, it cannot fluctuate that much, and assuming an existing economic environment and some projections that it's still going to be good and be stable. But another question arises.
One more comment on that. On a long-term basis, real estate is known to go up. Now, there are some volatility of fluctuations on short-term basis, but on a long-term basis, rent growth is one of the most powerful hedges against inflation. Real estate
100%,
is known.
yeah.
Real estate is known as a great hedge against inflation on a long-term basis. So even during the periods of elevated inflation, periods of low inflation, real estate does well. And the reason it's so attractive right now is because interest rates are high on a relative basis, and rent growth has been somewhat stagnant. But there's a lot of limited supply. There's new supply in multifamily real estate. New constructions have been very low in the last couple of years because of the high interest rates. So the general expectation is that rent growth is supposed to pick up and accelerate from 2026 and beyond. So the best time to buy now in 2025 when you have undervalued, underpriced assets.
Yeah, maybe final question on that issue. The other question arises here is that what strategies can investors use to relocate their capital into real estate without giving up the potential for growth? So in other words, how does multifamily provide both immediate income and long-term appreciation considering the existing environment? Because that's what some people might be thinking. Okay, I'm giving up a lot of growth right now, potential growth for AI, for crypto. But what about real estate? Is it going to be there both, like dividend plus growth here?
Sure. So a couple of quick comments. For one, if a portfolio is heavily overweighted in these appreciated assets, it's only prudent to take some money off the table, still leaving you enough upside in those strategies that you've enjoyed and have had a great ride, but move some portion of the portfolio into real estate. And the reason real estate can be very attractive for a couple of reasons. So of course you have to look at project by project. Real estate has fully stabilized properties and they have value add properties where there's an opportunity to force appreciation through value add work.
Yeah.
So value add obviously is development, redevelopment, renovations, etc. While the performing or stabilized properties present a typically a higher stability type of environment. So investors have a choice. They can go into stabilized projects, just buy them at a great price on a relative basis, or they can grow. They can go into value add projects where they can actually enjoy strong upside growth through the forced appreciation. So growth doesn't have to come in the form of market growth. That's the market forces. That's the tide that raises all boats. But growth can also come from forced appreciation. And the forced appreciation in real estate comes through the projects where the project sponsor make the improvement investments, increasing net operating income through higher rents. And that can be done simply through the work of the sponsor or the operator. And that's what I'm talking about is if you can buy existing assets at a great price and a great existing cash flow and further grow the value of the asset through innovations and improvement, that creates it's a win-win, not only in the current cash flow and the safety, but also in the growth, the forced appreciation. And if rents grow on top of that, that's a third factor. That's an additional tailwind to the overall picture. That's why, on a relative basis, it's so attractive because you have the cash today, you have a cash growth tomorrow, you have appreciation related to the growth of NOI, and you have also safety from the point of view that you're buying when the interest rates are high and you're buying on a great fundamental basis, cost per door on a relative basis relative to the reconstruction cost, because inflation is still there. So one of the things that most people don't really appreciate, inflation has cooled, but the prices are still high because inflation was very, very hot last couple of years. So one of the difficulties why many folks struggle with today is not high inflation, but high prices. And the high prices create the reconstruction cost floor. So a lot of these assets in real estate trade can get a steep discount through inefficient markets, through a motivated seller situation, and get into a great deal versus publicly traded securities. The market moves really fast. You have a little bit of dislocation in the market, and the market forces move the price up or down. Well, in real estate, it's an inefficient market. There's opportunity to get a phenomenal deal without the market being fully aware of it.
Well, let me address probably another group of questions that comes from a more conservative group of investors here. Thank you for your answer, though. A lot of people think about balancing their portfolio with treasuries, which is liquid, versus real estate. And they might want to have like highly volatile AI or crypto stocks and bundle that with treasuries. So in your last article that you released, you compared like returns in a Waverly project that Tempo is involved into right now. So maybe you can explain a little bit how would investors still gain from investing into real estate versus balancing their portfolio with treasuries? And would any falling or balanced or stabilized interest rate affect that? Because treasuries is a function of that at the end of the day.
Sure. So let's dive into treasuries a little bit, and then we'll chat a little bit about the Waverly project that we have.
Yeah.
So treasuries. Let's talk about short maturity versus medium versus long maturity. So short maturity treasuries are typically under 1 year. So 3 months, 6 months, 1 year treasury maturities typically provide a predictable yield, and they don't fluctuate much in price even if interest rates fluctuate. Medium term, especially longer term treasuries are very sensitive to the interest rates. So as rates rise, the prices fall, and as rates fall, the prices rise. So there's volatility, even though the treasuries are very safe if you hold them to maturity, but the risk, they do carry risk related to the interest rate fluctuation. It's one of the things that most investors don't always realize. So the interest rates, they are where they are. And we can make the basic assumptions. If the interest rates fall in the upcoming 6 months, a year, 2 years, you have some appreciation in the price of long matured bonds. And the converse is true. If the interest rates somehow rise with a high inflation, then the bond prices will fall. Right? So that's a risk related to the interest rates volatility. Now let's compare it to a deal like Waverly on the Lake. And the current coupon, by the way, in treasuries, the entire range of the yield curve spectrum today, we are doing this recording in very late January, is from low 4% range to the high 4% range. It's between the 4 and 5%, depending on the maturities. And the yield curve is normalized. In other words, longer maturities have a higher premium, higher interest rate for the term maturity, which is a normal state of the market, this is exactly how it's supposed to be. For years, we saw inverted yield curve. Now we see a normalized yield curve. So now if you go and look at projects like Waverly, it's got a coupon from the start, projected coupon 6% per year, which is already above the treasuries. So on a pure cash flow perspective, that deal could outperform the treasuries just based on that. But of course, it's an equity investment which carries generally higher risk than when you are in treasuries backed by the full faith and credit of the United States government. But treasuries will have the volatility related to the interest rates. Now let's look at what happens to a project like Waverly if the interest rates move in each direction. If the interest rates move up, it typically means we're seeing high inflation. It's just there's a reason the interest rates move higher. Typically, it's higher inflation. High inflation means higher rent growth. Most of the times during inflationary periods, rent growth keeps up with inflation. You see this is a normal, typical scenario. Of course, there are market by market volatility and fluctuation, but in general, rents grow at least with inflation. So as interest rates climb, the higher rents compensate. Overall NOI is where real estate sees this appreciation. So the cash flows typically improve from the rent growth as long as the mortgage rates are fixed for some amount of time. So the projects that have fixed interest rates, they're downside protected from interest rates climbing. And as the interest rates climb and rent growth accelerates, that grows NOI and grows valuation. Let's look at the opposite direction. What if the interest rates fall? So if the interest rates fall, the beauty about real estate is typically gives investors the ability to refinance at the low interest rates. And even if a mortgage has some prepayment penalty, valuations improve. As interest rates fall in general, valuations improve simply based on that. Sometimes you have a correlation of both events. You have the rent growth, which is healthy, and for some other reasons, the interest rates fall. If you have those two circumstances happening at the same time, you have a double tailwind. You have essentially strong NOI growth, plus you have lower cost of financing, and you wind up with absolutely accelerating returns. And if the interest rates don't do anything, then the treasury's return will be equal to the current yield, right? And if the interest rates don't change for value add, deep value buy, like Waverly project, what happens is the project still cash flows strongly because it's bought at a cap rate of around 9%. It's a phenomenal price. Plus, rent growth is still there, plus the value add work. So when you compare and contrast, even an equity deal on a relative basis could look way more attractive on a risk-adjusted basis than what something that appears to be ultra safe. And for some investors, if they want safety of treasuries, that's wonderful. As a way to park cash, treasuries, especially short maturity treasuries, are wonderful. But when you have a deal like Waverly in front of you, where it's a deep value buy at a phenomenal high cap rate, low cost per door, great value at upside, you try to compare and contrast. And what do you see? You see that's the time to sell those treasuries, take the cash, and consider it putting it into an equity of a deal that has great asymmetric return. If you look at some of the most successful investors in the history of the world, when they see a great opportunities, they move in. And it feels like the market in this particular deal is an example of that. Of course, everyone should do their own underwriting and review. And some people might find, hey, maybe there's a better deal. Absolutely, it's possible to have even a better deal tomorrow. But when you know you got a great deal in front of you on a relative basis, sometimes you take the opportunity to act today because you don't know is tomorrow be a better deal or not. The decisions are based on the best information and the best available deals today. And that today, it looks like a phenomenal opportunity. It's another important element. Most people are looking for perfection, the lowest part of the market. They want to buy at the bottom of the market. But how do you know there's a bottom of the market? You can only see that in arrears. Sometimes you look in arrear and you already missed the bottom of the market by 6 or 12 months. It doesn't mean you've lost all the opportunities ahead. But based on the current market condition, it feels like the bottom of the market is already, the bottom has been formed and we are in the recovery phase.
Yes, I completely understand and recall what you were saying. Speaking about Waverly, I mean, you just said about it that's why you have treasuries. That's why you have cash on account, because you're still expecting, if you're an investor, for a good opportunity to be on the table. And it sounds like you don't want to hold it all like for 3-4% over there in your account. You want to reinvest it in something like Waverly and be successful. Maybe my final question, and we can wrap it up. So in 2025, do you think that majority of investors would be willing to shift from those overvalued currencies into real estate as a hedge, as a risk adjustment instrument, both delivering return right now and a potential growth in the future? What's your gut feeling? What do you think about it?
Well, it's a personal situation. I give absolutely no investment advice. Each investor should consult with an individual professional, CPA,
100%.
advisor, attorney, etc. It's all different. In general, those who have been very, very cautious and sitting on sidelines for a significant amount of time might find that the opportunities in commercial real estate, in multifamily, as an example, are great if you can actually take a minute and look at those opportunities. Some folks actually looking for a recovery to be full steam ahead before they want to move. It's different. Some people are looking for reinforcement, and some folks may look at it and say, no, I'm perfectly happy in treasuries, and I don't want to do anything else. What's really amazing and fascinating, it's a good friend that invested with us. By the person's admission, was sitting on a large position in treasuries for a long time. And the person approached me and said, I got a humongous position here. I've been sitting on this long time. What should I do? I said, I don't know what you should do. Do you have any great deals? Can I get a better yield than 4% plus? At the time when we had the conversation, it was 5%. So of course, there's phenomenal opportunities. The banks are lending less. You could be in the private lending business. You could be participating in some of our lending funds like Temple Income Fund. You could get much higher yield without taking necessarily a much higher risk if you just open your eyes. But if you're looking for deep value, you can still play in both. You can play in the debt side. You can be the first lien loan, private lending, hard money lending, like Temple Income Fund. Or if you want to participate in a specific strategy, specific asset, and you want to look at that particular transaction, then you participate in a project like Waverly. But the time is short. You got to act from the point of view that this project is a syndication. It takes 2 weeks when we raise capital, then it's gone. And at that point, you don't have the opportunity to participate in the deal. So that just means you have to be plugged into the ecosystem with us and be ready to write the check when a great deal comes in. Of course, review it with your CPA and attorney professional to make sure it's right for you and your individual circumstances.
Okay, Mike, thank you so much for your time. And I think it was a pretty comprehensive overview on what's real estate right now compared to what's going on in stocks and volatility and diversification. Thank you so much, and talk to you next time.
Thank you, Misha. Thank you all.